Good morning, welcome to the market view for Thursday the 26th of June 2014. Starting off with the 30-minute chart for yesterday, you can see that we had three signals for the British pound yesterday, but none of these were filled, unfortunately. There we see the market moving to the upside, and the same at 1400 after the 1:30 news, and that's the GDP figures, which we'll come back to in just a moment. And then we see a sell signal which wasn't filled either in the afternoon, and it's probably not too dismal actually, because we had a range yesterday of just around 50 pips, so to actually get 20 out of that would have been very difficult there. So we're still stuck in this narrow sideways range. However, it looks like on the chart here we're about to be filled on the upside for the British pound this morning, so that's encouraging. We've actually got a move in the market here. Let's just have a look at the daily charts, see where we are. We can see the market yesterday trading down to the 76% that we drew in on the 25th market overview there, and we can remove the 62% there. The upside target for today, let me just mark this up for you and get the right one there. So the first upside target I will be looking at is going to be 170.11 there. And 170, of course, where the 62% is. I'm just going to remove that and make it a bit clearer. So 170.11 is the first upside target. However, today you want to keep in mind, news-wise, that Carney is going to be speaking this morning at 10:30 a.m. So he's going to do whatever he can to boost the pound. No doubt he's going to vacillate about what he's going to do on interest rates, which he has done now since he took office nearly 2 years ago now. Still not making a decision, and just putting it out there to scare people, possibly to not go out and get mortgages and things, so he doesn't have to raise rates for the reasons that I stated yesterday. Unemployment claims out from the US, they're the weekly ones at 1:30, not too concerned about those, and then that's it on the news front. So coming back to the pound, we've got this, the pound moving higher at the moment. It needs to go through 170 and then 170.11, first target, and then we keep the other targets in as well. If Carney does manage to boost the market, watch these areas of resistance and all the way up to 170.50, where we've got resistance at the moment. The market's been through this twice, looked at it a third time, and then come back down 100 pips over several days, not in one day. So again, very tight sideways range for the market. In the Dow yesterday, we see the implied volatility moving higher again. And no surprise, really, because the GDP figures that we talked about yesterday were forecast to be minus 1.8. The previous, they were minus 1. They came out at a shocking minus 2.9. And what was the market's reaction to this? The Dow went up. Now, on the overnight or early morning session in New York, the market did react to this. It dropped sharply of around 10 points, 20 at the max, turn around, and then the market moved higher throughout the trading session. So why on earth did the market move higher when the GDP figures, and there's a brilliant article here from Zero Hedge. I don't like the way the BBC reports the news. I tend to call it the biased broadcasting company. And it just talks about US economy suffered worst performance for 5 years in first quarter. The economy shrank at an annualized da-de-da. It goes off giving all of this usual humdrum spending downgrade. But then when you look at Zero Hedge, you get the charts, and then you can really see what the figures mean and what it means for the US. And there you can see we have a downtrend in GDP and in its breakdown of each individual component as well. There's more graphs there, and then you see this one where the GDP has fallen off a cliff. And yet the Dow moved higher, and the reason for this is that Yellen may have to get a checkbook out shortly and write a few checks to try and boost the economy once more. It doesn't work. It will never work. It's a debt-based economy. Debt-based economies do not get out of debt by printing more debt. But that's another video. So there we can see that the GDP worst since 2009, and the Dow Jones has moved higher. So keep an eye on the 76% retracement. We are due for a correction, no doubts about it, because the implied volatility has turned around and kicked up as well, where it looks like there's some sort of position taking going on to hedge positions within the stock market. Whether it's a big correction or not, I don't know, but it's certainly consistent with one coming into the market. There's no doubts about that. But again, because the market is so detached from reality, we could see the market go and test 17,000 first before. And so keep that in mind as well. We have got this 16,970, and a close above this would take us 30 pips up to the 17,000 area, which we see here. So it's just a matter of letting the market tell us what to do. Right, well, that's it from me this morning. Short, brief, and to the point. Let's see what Carney has to say with regards to UK interest rates. No doubt he's going to skirt around the issue as normal, and we'll see how the market reacts to it. That's it for now. All things being equal, see you in tomorrow's market view. As ever, thank you for your support. It's very much appreciated. Also, the feedback received as well, asked about the market view. And yeah, the market view is here to stay as long as I'm here to actually record it. So it's not something that's temporary. I will be giving a rundown each morning of what's going on. So be rest assured that as long as I'm upright and breathing, then there's a market view will follow. Of course, apart from the odd 1 or 2 days when going away. So as ever, thanks again, and I will see you in tomorrow's edition.